Hello, everyone. Welcome back to Your Money Matters. I am Angela Giroux, publisher of the Bauman Letter, and joining me are Ted Bauman, editor, and Clint Lee, research analyst. Now, as I always like to remind you, if you're interested in finding out more about the Bauman Letter and seeing what special reports we've got in store for you, there is a link below, so I invite you to click, check it out, and definitely I think you'll be happy with what you see. But today, it's all about rotation, rotation, rotation. We've been saying it for some time now. And now Citibank is saying that every presidential vote in at least the last 40 years has sparked a potential rotation from one part of the market to another, no matter who is elected. Ted, you hit on this a bit in your Friday video, and you were talking about how Wall Street's earnings estimates for 2021 consumer-oriented sectors have risen sharply. Now, Clint, I'm going to ask you, do you see evidence of this rotation on Wall Street?
Yeah, just recently, we've absolutely seen evidence come into this rotation. And it's a huge change from the prior peak in the S&P. Going into early September, there was a lot of narrowing participation in the market's rally up to that point. You had a lot of the large cap or mega cap tech growth names driving the market higher, and that eventually became unsustainable. And we saw it happen. We had that peak to trough, about a 10% correction in the S&P. But just in these last several weeks, when we've seen this rally set in, there's been some very powerful sort of internal statistics around that rally. And I'll show you what I mean with a few charts here. So the first thing I want to show you is a chart of the S&P 500. It's the black line on here against the Russell 2000 ETF IWM. So that's our gauge for small cap stocks. And this goes back to that prior peak in the market, sort of early September, and what's happened up to this point. And you can see the green line, small cap stocks have surged higher off those lows and are leading large caps. And that's important because when we talk about the mega cap names in the S&P, the top 5 stocks in the S&P make up somewhere around 25% or just below that of the index. Well, the top 5 names in this Russell ETF only makes up about 2% of that index, of that ETF. And so to really get this surge in performance, you need to see a broad participation. I mean, everyone in that ETF needs to be rowing in the same direction, so to speak. But that's given way to some other items that I've been paying close attention to, some very powerful, like I said earlier, internals. And so one example of that is tracking the percent of stocks that are trading above their 20-day moving average. And I'll show that right here with the this blue shaded area. Is that statistic corresponds to the scale on the right. And then I've overlaid the S&P 500 too. The first thing to pay attention to is the arrow on this chart. That was sort of that prior peak in the S&P, but look at where this other statistic is, this percent of stocks above their 20-day. It was only about 50%. So only about half of all stocks were actually in a short-term uptrend as the market, the S&P at least, was making its way higher. Then you had the decline. Eventually everyone kind of got caught up in the decline, and you had 85% of stocks eventually in a downtrend. But then look at this surge coming off those lows. I mean, this statistic is now right above or just above 80%, got above 80%. You really have to go back to the rally off the March lows to see a number comparable to that. There's one other stat I want to highlight, one other ratio I want to point out, and that's the advanced decline line. You look at however many stocks on a given day are advancing relative to the numbers that are declining. There's a couple different ways to look at that. The first way I'll show you is here with a ratio. So you make a ratio of that advancers to decliners. In this chart, that's this blue line, this blue shaded area. And once again, I've overlaid the S&P. Now, this goes back a couple months. On a kind of a typical up day, this ratio would be about 2 to 1. So you'd have 2 advancing stocks for every 1 declining stock. But we can see on the right-hand side what I've circled in the early stages of this rally these last couple of weeks. That ratio got to over 6 times, almost 7 times. So 7 advancers for every 1 decliner. And that's important because usually you have to see institutional buying activity to see a number that high. So just that, and that's the smart money, right? So to see those flows coming into the market to push that number so high, that's important. That signals a smart money, wanted to own stocks right here. But there's one other way you can look at this AD ratio. What a lot of market technicians will do is on any given day, take the difference of advancers minus decliners, and they'll add that to the prior day total. And so they kind of create this running tally, this running line of what this advanced decline stat looks like. And that's the last chart I have for you here. Now, the solid line here is that advanced decline line, and then the bar chart is the S&P 500. And there's two areas I've highlighted that I wanted to point out. And it's really been a tale of two different advanced decline ratios. The first one on the left, when the market was making a new high, this AD line wasn't. It was below the prior high. So that was a warning that flagged the decline that eventually set in. But look on the right-hand side of the chart now, what's happened recently is that even though the market hasn't made a new high, this AD line has. So that's just another way of looking at what the average stock really is doing, and it's leading the way higher. And that's why I say that supports sort of this notion that we're seeing this rotation really start to set in now.
Well, it's interesting, Ted, and I'll turn to you on this one, because we are seeing that, they're starting to trend higher. And according to some experts, it's because we could possibly expect this sort of blue wave come November, which on the surface doesn't seem to make much sense. If Democrats are in control, that means more taxes, more regulation. So where does that leave us, Ted?
Well, first of all, I think it's important to understand that the relationship between taxes and economic growth is not what it is commonly held to be. In fact, the most dominant interpretation is that taxes automatically hamper economic growth, but that is absolutely not supported by the evidence. And in fact, I think what Wall Street is recognizing is that in particular circumstances like we're in right now, you can pay higher taxes as a business or as a financial institution or even as an individual and come out ahead at the end of the day, because those taxes will be used to spend on things that will spur economic growth. So let me show you some evidence on this, because I think this is really, really important to understand. We have got so caught up in the ideology of this issue that we've forgotten that the government is an economic role player. And in fact, throughout most of the 20th century, it was the one that helped us get beyond recessions. The first chart shows the relationship between US tax rates, marginal top tax rates, and GDP. Now, there's a pretty clear trend line. I know it's a scatter graph, but essentially, the evidence shows that you actually get faster economic growth at higher marginal tax rates over time. Why would that be? Well, because when the government is taxing, it is going to use that money to pump back into the economy, generally speaking, and that makes sure that that money gets spent as opposed to getting put under the mattress or maybe used to play in the stock market. And that's the thing that I think a lot of people miss, is that when taxes go down, it doesn't necessarily mean people are going to use that money to invest. They can do other things like chase stocks. Second chart shows a relationship between the 3-year average GDP growth and the effective corporate tax rate in the United States. As taxes have fallen, GDP growth has fallen. So again, there is no empirical evidence that shows that lower taxes cause faster growth. Now, I'm going to take a bit of a liberty here and show an old chart from economics textbooks to explain this. And this is what's known as the 3-sector model. Essentially, national income operates like a circle. Companies hire people, they buy capital, they then use that money to make goods, which they sell to households. Households give the firms money. Both households and firms pay taxes to government. People save, it goes into the banks use that to fund investment. But then government can also purchase goods, and government can pay wages and salaries and employ people, or simply make transfer payments. Now, the important thing here is that if for some reason firms and households are reluctant to spend, firms on investment and households on goods and services, that means that the overall level of economic activity is going to go down, because the flow of income through this circle is going to reduce. In a circumstance like that, the government then steps in with its 2 green arrows. It puts more money into the economy. And if that money is spent on useful things that are desperately needed, then it will encourage firms to invest and it will encourage households to spend. So fundamentally, this is what Wall Street is seeing. People on Wall Street are not ideologues. They're out there to make money. So they make decisions based on what is real. And they know these statistics. They know these facts. They know that this is the way the world actually works. And my guess is that they're willing to pay higher taxes in return for a government that is actually going to be able to spend money on fixing highways or fixing bridges, possibly primary care education for pre-K, pay for childcare, let women go into the workforce. All these things that are associated with big government and Democrats are actually good for the economy, in the sense that they interrupt that holding on of money, this unwillingness to invest. either by households or by firms, and actually get the money out there. And they think, yep, that's going to be bullish. We're going to make money off of that, more than we'll lose by higher taxes. And I don't care whether you're a Democrat or Republican, that is what Wall Street is thinking.
I can't wait to see the comments on this one.
And like I said, it is something that we have just not been able to grapple with at the level of actual empirical reality because of the ideology around it. People will come out and they will say higher taxes mean less growth, and they just say it, but that doesn't make it true.
Sure. So that being said, what should investors do with this information?
Well, Clint, I'm sure you got some ideas too, but we have shown a lot of ETFs and over the last couple of weeks and months in our YouTube series and also in our Bauman Daily articles, where we've made a lot of recommendations. And essentially, if you look at cyclical sectors, particularly industrials, you're looking at companies that have very low price to earnings ratios relative to the market as a whole, but have strong earnings forecasts like the ones I spoke about on Friday. That's where to look. And fundamentally, just put on your thinking cap and think, if the government spends money the way that Democrats say they're going to spend money, where are companies likely to benefit? Honestly, that's where you're going to invest. Wall Street's already doing it. Clint, what do you think?
Yeah, I mean, we've written a lot about the topic. We've spoken about this on several videos. So yeah, absolutely. Go back and check those out for some of our past recommendations. We've also talked about the international rotation happening on an international level here as well. But if you're looking just domestically and you want to be a little more diversified, one ETF that I would throw out there is the Value Factor ETF, VLUE. It's a little more diversified across sectors, but that gives you sort of that value cyclical exposure as well.
Right.
All right. And that is a great reminder for anyone watching. If you are not signed up to receive Bauman Daily, that is completely free. You get more ideas like this. Again, some ETFs, some sectors that you should be looking at. There's a link below to join that. And of course, if you want more specific recommendations, please join the Bauman letter. Ted and Clint, have a wonderful day. Thank you so much.
Take care, everyone.
Thank you.